joining me. I mean, I think we should look at how the poll results are coming in and let that determine our discussion to a degree of what we haven't looked at. It broadly overlaps with the things we wanted to talk about, so that's handy. There's no particular curveballs there. But I mean, cyber is there, and it's something that we did want to, talk about. And Noel, as someone with great expertise in cyber, you were on our panel last year. But now it's just part of your portfolio. I suppose one thing that's happened since last year is the CrowdStrike event, and I think what was interesting about that, not being a cyber hack, but something that showed the interconnectedness of the kind of global corporate sector, its reliance on a few kind of software vendors, and how quickly a problem could spread in a way that disrupted businesses all around the globe at exactly the same time. What did that tell us about cyber risk as we look kind of forward, or what lessons should we draw from that?
Great question. First of all, good afternoon, everyone. It's a pleasure to be here with you. The CrowdStrike event was a hugely instructive one. Now, for anyone who's involved in the cyber industry, single points of failure are a massive concern in terms of how you write and engineer your books. I cannot like Microsoft as a client at all, but if I write a large swath of the industry, I'm exposed to Microsoft because 85% of my companies are using Outlook and Word and the whole Office suite. So regardless of whether or not I like them as a company, I'm exposed to them. There are several sort of companies that fall in that bucket. Amazon's another one with Amazon Web Services. And if you were to talk to CISOs of the Fortune 500 companies before the CrowdStrike incident happened and said, what is a gold standard product? CrowdStrike and its Falcon products is number one. So we have an event, and there are a couple of things that happen in that event which allow it to be both scary, touching on the single points of failure, but given that it started in Asia and sort of moved across the globe, much of our US sort of client base was asleep when it first happened. The way CrowdStrike is architected is in such a way that you could have issued a fix, and that fix could have been highly deployable in most of your customers. By the time our heavily insured US-based companies are awake and operational, the issue is mostly quelled. So a couple of issues there. Number one, the fact that there's a lack of insurance in other areas of the world means that the ultimate fallout was mitigated from an insurance impact. And if that had started in the United States, it would have been a different situation. Yeah. Second thing to consider is maybe it's an example of how it actually works if something is good. A massive kind of vulnerability shows itself, and the world is able to patch it and get on with it within hours. Yeah. That might be a success story as opposed to just something to be afraid of. So single points of failure are a thing. It's very difficult to manage that on the insurance side of life. If you're on the reinsurance side of life, it's even more difficult because you're aggregating aggregations. But I think CrowdStrike was a good story for a number of reasons. If you talk to those same CISOs now after the CrowdStrike incident and ask them what their gold standard is, they still say CrowdStrike. So managing that risk as something that can happen across the industry is something that we have to do. It's the bread and butter of what we do.
Yeah. Rachel, can I bring you in? What was either your response to that, or how does that maybe change your thinking about because this panel is about the medium and longer term threat, and obviously at Lloyd you've done a lot on the threat from systemic cyber and the quite scary numbers you've come out with on the potential kind of global losses. But what did we learn from that event? Or
so I think CrowdStrike was such an interesting event because one, the companies that have deployed CrowdStrike are those that care about cyber health in the first place. So ironically, those companies that actually wanted to protect their cyber, really cared about cybersecurity, were the ones that were the most affected, and those that couldn't care less have not deployed CrowdStrike and were okay. So it was a slightly ironic event. I agree it was patched very quickly. I mean, that's because it was non-malicious. Had it been malicious, this would have been an entirely different outcome. I think it's been a helpful warning shot for the industry from a medium to longer term to go, had it been malicious, how robust were the RDS assumptions, the realistic disaster scenario assumptions that we have in place for a malicious cyber attack? Because we've seen how quickly now something can flow through. That was non-malicious, it got patched, and it was okay by the time it hit the US, and the US was open. But if it had been malicious, and then you're suddenly having to wrestle the systems back and get a patch in, and you don't actually have control of the system, all of those things happen. Where are we sitting from an aggregation point of view? How scary is it? And also to the point, what really flowed through for me on that, the wordings were all completely different. So when I'm panicked in the morning ringing round the major cyber insurers in the Lloyd's market going, please tell me quite how big this is, what exactly is going on, and what's the exposure that we have, because the first thing that we do at Lloyd's is try and work out what's going on. I'm getting very different answers from, it's okay, we have sublimited cover for non-malicious, for this kind of act, to we have full limits cover, to we have no limit, to we have no cover. Wildly different wordings.
And how long before it kicked in, the cover as well?
And how long and the waiting periods were all different as well.
Yeah.
So that was also quite interesting. Of going, and I was talking to some cyber insurers going, well, did you think that this was covered? And some were saying yes, and some were saying no. And I'm like, well, that's interesting as well. So I think some of this is, I feel, although cyber is, 25 years old as a product, it's still quite young in the way it's developing. And I think it's the one where, it has less case law behind it. It has had fewer trials and tribulations that some of the other more established products have had, which is what's really helped us work out what is and isn't covered. I think this has been quite helpful to shine a little bit of a light on some of the wording, some of the aggregation, and just going what could have been, because it could have been phenomenally expensive for the industry had it been malicious and had it started in the US.
Nadia, do you want to come in?
Yeah, I mean, from an underwriting perspective, the challenge is this segment is the fastest growing segment, 35% year on year, and it's evolving quicker perhaps than we could keep up. And there's lack of historical data. There's lack of modeling. It's evolving. I feel like it's the beginning of sort of cat days with modeling. And as mentioned, some of the wordings are being piecemeal from other segments, and there's no consistency in coverage. So it is a challenge. At Vantage, we have hired cyber underwriters. We'll talk a little bit about data and analytics, but that's a huge value proposition for us. So we're using data and analytics. We're using third-party scanning technology to address it, as well as we've also partnered with some specialists who write a different segment who are also using technology for risk selection, et cetera. And so we're sort of sharing knowledge there as well.
Thank you. And I want to bring in as many of these topics as possible that we put to the audience. Climate risk is something we've talked about a lot today. Nadia, I want to kind of bring you in. But maybe we could, to differentiate, talk about the longer term threat from climate change to, the question would be, are physical risks being underplayed over the longer term? We've talked a bit about flooding today, but rather than the kind of year-to-year underwriting view that the insurance sector provides, how about the kind of over decades, especially given what we heard on the climate change from the professor earlier, the degree of sea level rise? Yeah. How do you kind of attack that longer-term question? It'll be a hard one to start.
It's a hard one to start, but it's a good one, and it's one that we obviously get asked frequently. We get asked the questions all the time, are property cat rates now at a level where we think they factor in all the risks imposed by climate change? And I think that question is tackled best from two different angles. One, obviously, we have seen rates rise to a level highest in the last 2 decades, which is great. We have seen performance improve with that on reinsurance results. That's all great. But I think speaking about cyber and the recent event as a reminder, we've also on the property cat side just had a recent reminder. What if Milton goes a couple miles further north and does hit that 100 billion Lloyd's RDS scenario? As an industry, we shouldn't be sitting here when something like that comes our way, speculating who will still be alive the next day, who's going to be bust the next day. That shouldn't be us. It should be us all prepared and ready to withstand a big industry event. So I think that's factor number one, that we are undercooking some of the medium-term risks, because clearly as an industry, we're not quite ready for that.
On that, are you interacting more at all with banks, asset managers, on them? Because them getting a longer term sense of the insurability of the collateral that they have. It's obviously something that prudential regulators care about a lot, but we're only starting to see lenders who rely on insurers for that kind of year view that something is insured right now, but they don't seem to be asking insurance companies, or are they asking insurance companies, is this entire kind of like housing estate going to be kind of underwater?
I think they are, and that leads to my second point, because quite noticeably, there's a lack of new entries in this hard market environment where we've really seen rates at a high, right? So why is there a lack of new entries? And that is because investors, I think, are a bit skeptical of us as the industry being able to keep pace with those ever-changing movements and keeping pace with climate change. I don't think they've got full trust in us.
Yeah.
So we need to do, as an industry, we need to do much better, one, explaining how we underwrite risk. At the Fidelis partnership, we don't really think the vendor models capture that change in risk adequately. We develop our own view of risk. We need to do a much better job in explaining how do we develop that view of risk and how does that go into underwriting. And then secondly, take those investors on board and really explain what our long-term vision is with this industry and where we're going to go, how can we factor that in.
Noel, can I bring you in there as well? It's something that AXE Group has looked at a lot, obviously, as a big, primary home insurer too. How do you think about the longer run risk?
I think Nadia made a lot of good points there. What I would add is, the only real way to properly and responsibly write risks when the level of uncertainty rises is to add a margin of safety to your pricing right now, right? So what that means is that the level of reliability you can have on your historical results goes down. You need to take your historical results and add an additional margin of safety because we don't know when the next Milton is going to be a couple miles higher and completely change the landscape. But we see it. It's gotten close enough that we see it, and we can't pretend that it's not. The plausibility has increased now. So this is where being in a competitive marketplace gets difficult, because when you perceive that you must add a margin of safety in order to be responsible, and your competitors don't, then you've got to figure out how far you're going to play the game with them in terms of who's going to be standing when this thing goes sideways. So it takes bold decision making on the part of the underwriters. It takes sticking to your guns and sometimes letting some business go, and being confident that making the right decisions now will mean that you're the one standing later on when everyone else has competed themselves down into where we don't make money.
Peta, do you want to?
Yeah, so the challenges reinsurers have is being relevant to our clients, and that's listening to them and bringing solutions for their problems. 2, it's being sustainable, and that means understanding the risks and being able to price for them, have your own view of risk. And you can talk about underwriting discipline, but it's really underwriting, pricing, and measuring your aggregations. And then it's resiliency, and that part of that is access to other parts, other capital pools, if you will. And climate change is definitely testing those. When you look at 2024 will be the warmest year in history. We've had a lot of records and firsts. So Hurricane Beryl was the first Cat 5, or the earliest Cat 5 we've ever seen. In October, we saw the first time 3 hurricanes at once late in that season, late in the season. And it's not just hurricanes. When you look at the number of days between disasters, in 2005 it was 60 days, now it's 20 days. And we also have to think about, and it was mentioned today, but population, people and infrastructure moving to more cat-prone zones. And so when there's more dollar losses in the system, there has to be more dollar premium in the system. But these are some of the challenges that we're facing.
Rachel, can I bring you in? Do you think there's any criticism in this view that this industry that focuses on underwriting for the year ahead has underplayed the longer run trends in the secondary perils in terms of the frequency and severity? That feels like part of the catch-up that we've seen in the past year from people saying, okay, we have to pay attention to those more. It's just interesting to me because the insurance industry for decades has been ahead on understanding climate risk. And yet when it comes to kind of wildfires and floods, it feels like somehow it fell behind the curve. Do you think it did?
Yeah, I still think we're behind the curve. I think that the ratings that we've seen have been playing catch up to the environment that we've been in, not forward pricing the environment that we are in and are moving to.
Yeah.
I think we talked about this on the panel this morning. There are pockets of innovation, which is maybe we can bring in, some of the AI and the data and the analytics. You look at some of the, and I think someone mentioned wildfire. There's some pretty cool technology at the moment that really helps mitigate some of the wildfire risks. It makes it much easier to insure wildfire risk. There's far more in the way of sensors, earlier detection, etc. So there are things that we can do in our industry that actually help our view of risk and help our ability to mitigate some of this. And I think we need to be embracing that, much more advanced data analytics. I completely agree with Nadia. The models they're just not right. They're just out of date. But there's lots of startups, lots of insurtechs that are trying to plug the gaps of the big vendor models. And I think if we can embrace them and really start to move forward, we will be able to get a better forward-looking view of risk.
Yeah, so let's talk more about using data and analytics. I think that was in our poll one of the top things that the audience wanted us to talk about and found interesting. I suppose there are just so many, and you said there's many startups, even in just the area of kind of risk modelling that are very interesting. But in each area of the insurance sector, there's tons. And I suppose that it comes down to a question of what to build, what's worth building, and how can it kind of improve the core of what you do. Noel, maybe start with you. What particular technologies, whether it be AI or not AI, have actually made a demonstrable difference to the way you work?
From a work perspective, this is an exciting time to be involved in any of this. The technology is right on the cusp of meaningful changes in how we interact, how we price and understand risk, how we transact. AI and associated, LLM sort of technology is going to be a force multiplier for us. I think what we're doing now is very nascent in terms of its application, and it's much more exploratory. So if I look at a company like ours, there are a lot of things in the hopper that are being tested behind the scenes in order to sort of bring these tools to life. We're going to be waiting for increases in accuracy. Right now, these things are just not as dependable as we need them to be. But the opportunity to ingest large amounts of data for large populations and to make sort of portfolio-wide discussions, make portfolio-wide decisions with much more accuracy is ultimately super exciting. On the other side of the spectrum as well, where we have large complex clients where you need to ingest a large amount of data just to be able to service the one client. What we're looking for is those correlations and those things that matter for risk that we just haven't seen before. And the data's always been there, we haven't been able to draw the connections. So that ability is coming, and I think...
Do you think that will change the role of the underwriter? Do you think that underwriters will increasingly underwrite broader portfolios of risks that have been kind of presented to them or kind of not aggregated, but brought together by some kind of technology rather than individually, or in terms of changing the output?
I think that depends on the market segment that you're serving. If you're serving large complex clients, Fortune 100 clients, you need to be able to understand the wide swaths or the wide differences between a Morgan Stanley and a Wells Fargo, even though they look like the same business doing the same thing. They're completely not. But when you get into smaller organizations or down even to the individual level, you are going to be able to see correlations that are going to help you make much more profitable decisions. And those things will be coming to the fore quite soon.
Nadia, what kind of data analytics tools have you found, or do you think we should get excited about into the future?
Loads, if I'm being honest. But the Fidelis partnership itself is quite a young company. So we've built our business model around technology. It's always been our core and the center. All our systems are integrated, interact with each other, and they're all very centralized to make sure that we can analyze data in the most nimble and efficient manner. From an AI perspective, I think there's a huge potential to make that even more efficient, to analyze data, large amounts of data in a very quick manner, which is also going to give us even more of a competitive advantage when it comes to responding to clients, responding to brokers. So there's a huge amount of speed and accuracy that will be added to that. However, I think one thing that we need to be cautious of, AI is a very young technology still. We need to implement the right security measures in order to get the outputs that we would like. There's a whole AI gets fed by human nature and human biases. So the right security measures need to be put in place in order to utilize AI fully. From an underwriting perspective, especially looking at the reinsurance side, but probably also at the insurance side, we don't think AI is there yet to fully replace the underwriting expertise that we've been building over decades. We are still in a people's business. The element of trust and partnership that we've built in those business relationships cannot be underestimated, and we don't think AI or any technology is there yet to replace that. However, technology is supporting underwriting decisions, but cannot replace the forefront of the decision.
Yeah, no, we hear you. Pete, do you want to come in?
So Vantage was formed in 2020, and we are a tech-enabled specialty insurer and reinsurer. Greg Hendrick, our CEO, talks all the time, it's great not having legacy reserves, but even better not having legacy technology. And it's actually part of our culture. Our tagline is we see risks differently, and it's not just the risk, but it's how we do things from hiring, and we'll talk about that in a minute, across the board. So it's really about the power of harnessing data and analytics and giving that to our underwriter for better decisions. And a third of our employees are in data analytics and tech, DAT. So that speaks to the importance and part of our value proposition. It's been a journey, and how we're set up is hybrid. So we rent best-in-class systems, like policy issuances where others have, created a great system. But we build in-house where we see opportunities and where we can differentiate ourselves. So we certainly our insurance studio, we call, and reinsurance studio, really about individual pricing, but also portfolio aggregation. And on the reinsurance side, we write specialty and property, and we have, for all specialty lines, a stochastic view. So marine, energy, composite, within composite, we have a complete stochastic portfolio view of our risk, which gives us pricing confidence, and certainly portfolio.
Yeah, no, understood. Rachel, I'm not going to ask you how Blueprint 2's going.
Thanks.
Maybe not so interesting to everyone in the room. But, I suppose you've got Lloyd's Lab. And what are the technologies you think that are going to kind of like change the way Lloyd's works over time, like if you think further out?
Yeah, so it's quite interesting, two very young companies. Lloyd's 330 years old, so we definitely have
Longer
legacy systems. Yeah, exactly. And Lloyd's gets counted in dog years, so multiply that by 7, and it's really old. So there's a lot of legacy there. And so what I think is, so when I look at the data in the AI space, what I'm seeing is, if you go back 4 or 5 years ago, everyone's like, it's a data lake, it's a mass data project, we're going to do data transformation or some kind of tech transformation. And we talked, there's been panels earlier that said, well, the tech has tried to do insurance and it's failed, but when insurance partners with tech, we suddenly have much more chance of success because the tech doesn't actually understand the insurance business. Where I'm seeing actual genuine leaps forward is where we're actually trying to plug tech in to solve particular issues. So not a broad scale, let's do a big transformation, let's do a workbench, let's do some modernization. I mean, all of those projects are now dying on the vine because they're just too complicated to implement across the insurance industry. But when you see people go, actually, do you know what, I really want to price wildfire better, there's some tech that can help me do that.
Yeah.
Or I really want to look at my aggregations over here, there's tech that can help me do that. Or I want to look at, I don't know, whatever it is, whatever niche, whether it's on the operational side, whether it's on the productivity side, whether it's on the pricing side, whether it's on the aggregation side, there is somebody out there that we see through the Lloyd's Lab, which is an incredible accelerator, and we've had one on the island, which was really successful, and we'll do more. So the Lloyd's Lab and other insurtech accelerators, you're just seeing companies trying to solve specific use cases, and that has way more chance of success than a broad brush, let's transform the insurance industry.
Yes. I just wonder whether over the longer term, Lemonade is not a dead company yet, and it does do certain things very efficiently. And so there's a longer term scenario where some of these new fully digitally built insurers that are using technology to kind of process things much more quickly, figure out the underwriting side, continue to exist, and are then a lot more operationally efficient than traditional insurers. And is that still a longer-term challenge to the industry, that it could be disrupted by the carriers, by the insurtech carriers? Or
Yeah, so if I think of what I think the Lloyd's market will look like in the long run, I think you'll see, and I talk about this as pressure on open market lead underwriters. I think you're going to see pressure on that from broker facilities moving up the value chain, or moving a broader use of broker facilities, like them or loathe them. They are here and they are expanding. Yeah. You're going to see then a greater proliferation, I think, in smart follow models, whether that's portfolio underwriting, whether that's AI augmented, whatever that may look like. And what they're doing is effectively automating what used to be the follow underwriter, which was a physical follow underwriter who used to go, all right, I know that person, that's pretty good risk, let me put a follow stamp behind them. Yeah. So therefore, I think your open market lead underwriter becomes slightly squeezed, but we've got to be very careful that we maintain them, because without the open market lead underwriter, there's nobody in the market to follow. And
do you not worry that even if the follow market gets more fully automated, does that not create a risk around whether there are enough actual human beings considering the price of insurance?
So it creates a risk, because at the moment the follow market provides some checks and balances on the lead market, and so I think it does create a risk. And so when I talk very publicly, I am nervous about the whole delegated space within Lloyd's. It's roughly 40% of the Lloyd's market. I think it's going to grow if the scenario I've just said plays through. Therefore, what we need to do from a regulatory perspective is really understand how to regulate different models and make sure that some of those checks and balances are in place. Yeah. Because, again, without a functioning open market, lead open market, there is nothing to follow.
Does anyone want to come in on that?
I think that's a really good point, and also focusing on specific fields. Because I think the whole conversation around technology, automatically as an industry, we go, let's automate on underwriting. Why don't we automate the processes that are easier to automate first and improve underwriting profitability with it? Talking about operations, the back end, how can we really optimize our claims handling? There's loads of processes related to underwriting that aren't underwriting that really need a proper revamp. If we look at those, because unfortunately in our industry, the spotlight is always on underwriting. So underwriting has been the part that's been driving forward all the time. So all the other functions have sort of been lagging behind in development. These are really the ones that I think need to progress and implement the new technology. If we can make those more efficient, then the whole underwriting operators is going to become more profitable before we then go into how do we automate or make underwriting more automated.
I just want to give the audience an opportunity to ask a question. We've got about 5 minutes left. Does anyone have a question for our esteemed panel? Otherwise, I'll forge ahead. That's fine. We haven't talked about talent and attracting people into the sector. It's been touched upon today, and we just had that brilliant diversity panel. I found it reassuring that mediocrity is evenly spread. Personally, quite a reassuring sentiment. But, obviously it's a challenge. For me, trying to give insurance a bigger platform within my newspaper and make people care about insurance that might not care about it. It's funny that insurance doesn't have the same kind of it doesn't have the same kind of enthusiasm, given it's a very much a risk-taking industry as banking does. You know, even though it might be the same exact financial risks being taken by a bank and an insurance company, and yet it seems to be discounted and found less interesting. Where have you had success in kind of dragging people that might not find insurance interesting into this, what we know is a very interesting industry? I don't know if anyone wants to take that. Peter?
Sure. Someone was talking earlier about back in the day, you know, at school we didn't know anything about the industry, and it's not fun and sexy. Well, back in the day, I didn't know anything. Back at school, I didn't know anything about this industry, but I do find it fun and sexy because it is always challenging us. So we need to do more around that. And if I could speak sort of maybe from Vantage's journey, again, startup, we had the opportunity with a clean sheet of paper on hiring the team. And we had challenges because we started in 2020, which was COVID. So certainly in the US, we have a flexible model. It's a mix of office, but mainly remote. And that allowed us to find the best talent. In Bermuda, we're 50 strong. And we took a very thoughtful and intentional approach on how we hire, and we wanted to represent as much as we could the population of Bermuda. So I'm extremely proud of that. We're 60% female and we're 45% non-white. And when there are other people out there saying, oh, well, these people don't exist and there's no talent out there, there absolutely is. And we hired in a different way. We networked with a number of organizations. We did a lot word of mouth, and we went into our community. But at the end of the day, I think it centers around your mission and vision, your culture, and purpose. And Vantage is a diverse company, and that's attractive, and that's just sort of exponentially made us a place to work at. But we're also going back to we see risk differently. One of our values is being curious and being innovative. And so we are attracting a lot of young, tech-savvy people who want to bring, that expertise to the market.
Noel, how are you thinking at the moment about?
I'll say a little bit, very similarly to Peter, versus New York and, say, London, where the insurance industry can be sort of a hidden gem. In Bermuda, it is where people want to be.
Yeah.
I fell into the industry 20 years ago. I did a degree in economics and ended up in insurance, and I got stories of friends of mine who did fine arts degrees who fell into insurance. Now, of course, in Bermuda, we have candidates that are coming back from university with risk management degrees. They're aiming at getting in our industry. We don't have a problem with attracting good people. We have a problem with convincing good people that they're good enough for our industry. That's been my experience. I think that Bermuda international business belongs to Bermudians in partnership with the internationals that make it all work. My platform has one expat in all of XL Bermuda on the insurance side. So we're a place where Bermudians are championed. We're a place where they are, where our culture lets them know that this is a place where they can succeed. And it's been huge for me to be a part of it, and I'm so honored to lead it with the way that it's structured. So, yeah, we have the opposite problem. People are looking to get in our industry. More and more people are realizing that they have what it takes in order to participate in international business, and they are finding that the different cultures, some cultures are more open to their participation than others, and we're turning them away as opposed to finding it difficult to find them.
Yeah. Nadia, if you want to come in on talent?
Yeah, couldn't agree more. We're fortunate enough in Bermuda that people know about insurance and reinsurance. This is probably the one place in the world where people at 6 years old say, I want to be an actuary or an underwriter one day. Certainly for me, coming from Germany, I didn't know about reinsurance up until I went to uni. So there's a very, very different situation here, and that's great. But I agree, we need to we need to convince people they're good enough for the space. We're in Bermuda, people know about it, but then we've got added challenges with our other offices in London, in Dublin, in Abu Dhabi, where people don't.
Especially in London, I often have with people is, how did, like, if a young person works in a broker, it's like, how did you find out about this industry? And the typical answer is, my uncle was a broker at Lloyd. And that's how I found out about it. So it's reaching, especially for that diversity point, the people whose uncle didn't work at Lloyd's. Rachel,
Exactly.
like, how do you do that?
But just quickly to finish that point, so what we want to do is to open up the industry to people who aren't in that exact bracket. Offering internships is something that we do every year in Bermuda with Big Brothers Big Sisters, which is a mentorship program for Bermudians here. We do that with the brokerage in London, which is also a mentorship program, introducing younger people who aren't from that inner circle to the industry with an internship, with an easy entry where they don't have to overcome that hurdle and think, I don't know whether I want to be in insurance for the rest of my life. That's kind of how we show them that this is an attractive place to work.
Rachel, final word to you.
So it's very London specific, but pretty much all insurance companies do outreach in sort of Tower Hamlets, which is pretty much where the offices are based. It is a pretty deprived area of London. And they're kind of swamped with insurance people coming in, trying to persuade them that they should work in the insurance industry.
I lived in Tower Hamlets for 10 years. No one ever came to
there you go. That's why you ended up at the FT. But I think we need to be broader in our thinking, and certainly that London Matters, part of one of the boards I'm on. We spend a lot of time going, where is the outreach that we need to do around the UK to encourage people
a lot of students into Lloyd's.
Bringing students into Lloyd's the whole time. Part of it's telling the story, but I mean, you said about banking. I came from banking. It was blooming awful being in banking in 2008 in the financial crisis. And then insurance came and said, would you like to come and do this? And I went, oh my God, it's like a counter-cyclical industry. This sounds like a brilliant idea. Right? And now I talk to everybody about what a great career it is. And I went to banking because that's what you did when you left university, and we need to change that story. And I think part of
university outreach from the banks is massive.
It's
right?
massive.
It's going kind of pound for pound with that would be tricky.
Banks, accountancy firms, because you worked for PwC for a bit as well, are the ones that are at the and insurance just doesn't turn up.
Yeah.
So it's very hard.
Look, we've gone over time. This has been a fascinating panel. Please join me in thanking these panelists. Thank you. I'm staying here. You guys go.
Okay,